Hi, this is James Allen with Steven Insalaco from Silverside Insurance, talking today about asset-based insurance. Steve, go ahead and take us away.
Hey, thanks, James. Today I'm here with Mickey Bell from our asset-based insurance group. Welcome, Mickey.
Thanks for having me, Steve.
Hey, so what exactly is asset-based insurance and why is it becoming so popular?
Well, conceptually, I typically summarize asset-based insurance as protection against one of your largest financial risks that a client may face during their retirement years, which, as we know, as long-term care expenses. On the other side of that, when we're describing the products, we typically relate them back to a three-bucket approach. So you have your return of premium. Depending on the product's vesting schedule, you have an income tax-free death benefit, and then there's also the long-term care leverage pool there as well. So depending on if the client needs long-term care, they have it. If they don't need it, there's going to be an income tax-free death benefit left to a beneficiary. And if they never need the care and they want their money back down the road, they also have that return of premium option available. So that's really what makes asset-based insurance more flexible, and it provides more guarantees that many other options cannot.
What would you say to an advisor on why they should sell asset-based insurance versus, say, traditional LTC?
Well, it's definitely not my intention to pick apart traditional long-term care products. I believe they play a pretty important role in the long-term care planning space when it makes financial sense for a client. But like I always say, having a plan for potential long-term care expenses is better than not having a plan at all. But over the past few years, we've seen many traditional long-term carriers exit the marketplace. Back in the day, there was over 100 of them. Now there's really a handful of major players. And then also a lot of these carriers are increasing rates on existing policies, and a lot of the new policies are a lot more expensive than what you could have bought 5-10 years ago. So an asset-based insurance product is going to provide the clients with, like I mentioned earlier, that three-bucket approach. It also helps them to repurpose an existing asset, an idle asset, for the long-term care leverage and wealth transfer. And then it also eliminates that use it or lose it idea or concept that traditional long-term care products have.
I see.
Asset-based insurance really is going to provide a benefit to the client no matter what happens or how their life plays out.
Got it. Are there different ways to fund an asset-based insurance policy?
There are. So a bunch of different ways that we can look at it, actually. When most people think of, or most advisors think of asset-based insurance, they immediately think of, I need to have $100,000 or $150,000 single premium available. If I don't have that, it's not the best solution for them or not a good alternative to traditional. But at the same time, there's a lot of different ways that we can fund these products. So you can use cash, you can use qualified money, existing annuities with out of surrender, cash value from existing life policies, and then in addition to just a single premium, very flexible now in their flex pay options with some of these carriers. We can do a 10 pay or a 20 pay or even a traditional pay. So it operates more like a traditional life or long-term care contract where the client's going to pay on it either monthly, quarterly, semi-annually, or annually for as long as they live.
I see. So that really makes it so there's a lot of options for the client to be able to move their money over to a product like this.
It is. So just, depending on their main goals and needs, we can walk through that with the clients and then run a few different scenarios and solutions for them, and then just making sure that it meets their clients' goals.
I see. And what happens if they want maybe a joint policy?
Yeah, so with most of our carriers, it's on an individual basis. So if the husband wants a policy, we would do one for him. If the wife wants a policy, we would do one for her. However, one of the larger carriers out there, been around for about 27 years in this asset-based marketplace, has a joint option available. They also have a lifetime benefit option as well. So you can do a husband-wife, mother-daughter, father-son, two sisters, basically anybody with an insurable interest on each other as a joint contract. You can add on the lifetime benefit rider. So no matter how long they need care, the policy is still going to stay in force and pay that monthly benefit. For instance, my grandmother required care for about 8 years. As we know, the average cost or the average length of stay is only about 3. So adding that lifetime benefit rider on there really gives them that extra layer of added portfolio protection, so they don't spend down or liquidate their assets.
Yeah, I don't think that people realize how fast their assets are going to burn out when they're paying for home-based care or an asset-based care type scenario.
Definitely. A lot of times we see people, or when we do joint sales calls even, they'll say, yeah, I have $100,000 sitting at the bank, and if I need long-term care, that's kind of my go-to money. And then we can bring up some statistics about traditional costs for long-term care. Do you know that a semi-private room in the state of Indiana is about $80,000 to $85,000 per year? So a little bit over a year in care, you've already liquidated that $100,000. How about we discuss an option where we can take that $100,000, reposition it, you still have access to it if you need it, and we're turning that $100,000 into $200,000, $300,000, $400,000, depending on the client's age and their health.
Yeah, and this is one of the essential things that our clients need, and they don't know that they need. The big trick here is they need to get it before they absolutely need it, before they actually are sick. Because once they are, the available solutions have dwindled dramatically.
Definitely.
What is an average asset-based insurance case size that you're seeing right now?
The average case size that comes through our door on a daily basis is right around $70,000 on the single premium. On the flex pay side, it can widely vary depending on the years that they're going to be paying those premium payments. And then also, on the flip side of that, we're seeing cases from $25,000 to $250,000 coming in daily. So it really just depends how much assets the clients have, what their main goals are. Do they only want to cover maybe half of those potential long-term care expenses and then supplement it with their retirement income? Do they want to cover all the expense in entirety? So it really just depends what their main goals are and how they want to play it out in the future.
I see. Okay. So assume I'm an agent that wants to get involved in asset-based insurance. How would I, as an agent, start to incorporate that into my plan?
Sure. Pretty easy. So having a meaningful initial discussion with your clients about long-term care planning up front. It doesn't have to be something that's product-driven, nothing that's even asset-based insurance-driven, but just discussing the need to have a plan for potential long-term care expenses if those expenses and those situations do occur in the future. Keeping it concept-driven, not worrying about a product. Once the clients recognize the need for the plan, the product's going to fall into place.
Right.
So our asset-based insurance team here, I'm always happy to help with case design, client sales calls, even discussing potential clients or pre-screening them ahead of time before they're actually applying for any type of coverage.
And I think that's an important point, because one of the things that I could see happening if they didn't have an agency like ours and your team to be able to walk them through is really for an agent to get overwhelmed if they're just, it's something new and it's got a lot of bells and whistles and things that I don't understand. I need somebody to help me and work me through. And, I'm glad that you're here with us and supporting us in this manner, because this is something that you do every single day versus some of our agents are, say, annuity writers. It's a completely different sale.
Definitely. And as we know, 70% of people age 65 and older are going to require some type of long-term care during their lives. Our goal for them and our hopes are that they don't never need care at all. They live a long, great life, but at the same time, if they should be falling within that 70%, we want to make sure that they're covered. A lot of the clients, or I guess almost all of our clients, think that they're going to be that 30% that don't need the care. But at the same time, if they have assets to protect, we need to make sure we're talking about long-term care planning with them, figuring out the best solution for them. If it's not asset-based, we'll bring up the other type of planning, either traditional or just a life insurance product with a long-term care rider. But anything we can do on our side to make sure that they're covered for those potential long-term care expenses if it should occur in the future.
Yeah, and I think you bring an important point, because 70%, like you say, of people are going to need that. If you compare that to how many people have fire insurance for our homes, we would never consider going without fire insurance because we're so afraid of it. And yet only 1% to 2% of people's homes ever burn down, right? Here we know that 70%, me or you or somebody else in the room is going to get sick at some point in their life, and they're going to need help.
Exactly. And that's our goal, to so that they never need the care. But if they do need the care, let's put some type of plan in place to take care of those. Just like car insurance, you never would drive your car around without car insurance. If you got into a wreck, $10, $20, $30,000 you'd be out of pocket. Whereas with long-term care, it's substantially more. You're looking at 10, 20 years down the road, it being over $100,000, $150,000 per year for a nursing home potentially.
Right. Well, these are some great things to think about as our agents are engaging with us. And I do want to really thank you for being on the show with me today. And one of the things I want to say to all my agents is, if you have a case, bring it to us. Let us look at it. Let us advise you on some of the best techniques. Mickey and his team are phenomenal at what they do, and they'll help you out. And like you said, they can help pre-screen and help you with the case. So
definitely, and that's what we're here for. Anything we can do to help enhance your advisor practices, that's what we're going to do for them.
Well, great. Well, thanks again, Mickey, for being on with me today. I really appreciate it. And if you'd like to know more, you can call Silverside Insurance at 480-998-1286 or visit us on the web at silversideinsurance.com. This is Steven Insalaco. Thanks for being with me today.
This is James Allen, and you've been listening to the Silverside Podcast.